Good afternoon, and thank you for joining me at today's Vincent's webinar, where we'll look at options for distressed companies as well as the insolvency landscape at the moment. My name's Henry McKenna, and I'm a director in Vincent's Insolvency and Reconstruction team and a registered liquidator. Vincent's provides insolvency and restructuring services to a range of companies and individuals throughout Australia, with a particular focus on the eastern seaboard. Now, here's just our standard disclaimer, which has to be included in all of our presentations. So if you could just read that, please. Okay, so the webinar today will cover three topics. Firstly, we'll look at some recent insolvency statistics, which have come from ASIC's website, to see what's been happening in the sector. Then we'll move on to look at what the ATO has been doing or not been doing, as the tax office has historically been the largest driver of new insolvency appointments over non-payment of taxes. Then we'll look at the different types of appointments that are available for distressed companies. The options are for both the debtor itself, in other words, the distressed company, or creditors who are owed money from the distressed company. I'd like to take questions at the end, if I may, to make sure we don't run out of time. If everyone could please keep microphones muted for now and put any questions you might have along the way in the chat. Thank you. Okay, so on to looking at some insolvency statistics at a high level. The graph on the slide shows quarterly numbers of corporate insolvency appointments of all types over roughly the last 3 years. Notably, there was a steep decline that began around the start of the pandemic in Australia in February and March 2020. The fall in insolvency appointments went against all the early predictions of a tsunami of liquidations and administrations. This has been mainly attributed to a few factors. The financial assistance measures like JobKeeper and the ATO cash boosts put in place by the federal government. The inability of landlords to enforce against tenants who hadn't paid their rents, the tax office not pursuing companies and their directors for unpaid taxes, and also the big four banks have also continued to go softly on defaulting borrowers in the wake of the Banking Royal Commission. Now, most of those factors have come to an end, and we can see on the graph a recent uptick in insolvency appointments starting in the middle of 2022. So this next slide breaks down the insolvency appointments into the main different appointment types. Court liquidations, which is the dark orange line, voluntary liquidations, which is the grey line, and voluntary administrations, which is the yellow or light orange line. There have been increases in all insolvency appointment types recently, although the number of court liquidations hasn't yet returned where it was 3 years ago, before the pandemic. This next slide looks at the breakdown of insolvency appointments in FY22 by industry sector. And you'll notice that the biggest piece of the pie is taken up by the building and construction industry, with around a quarter of all appointments. Not far behind that is the accommodation and food services, which wouldn't surprise most people, with the number of cafes, restaurants, clubs and bars that have shut during the pandemic, and the struggle to get staff and meet rising input costs, even if they did survive the COVID shutdowns. I'll ignore the grey section of the pie, as other business just includes too many industries that don't fit into any other industry types. And then retail trade is the other significant area that has shown a significant number of appointments. And this again probably comes as no surprise with the number of retail stores that have closed over the last 2 years as a result of lockdowns and people changing their shopping habits, while all along existing lease obligations have continued. This next slide just shows the numbers that behind that pie chart we saw in the previous slide. This slide just shows the rising popularity of a relatively new form of insolvency appointment called a small business restructuring, and I'll explain what that is a little bit later in this presentation. Now, this slide shows a couple of things. Firstly, there's been a recent significant uptick in the number of creditors' voluntary liquidations, which are liquidations initiated on a voluntary basis by the company itself. And secondly, and you can probably even barely see it, are the minimal numbers of simplified liquidations which are occurring. And I'll explain what a simplified liquidation is later in this presentation. Now, I know this is a presentation on corporate insolvencies, but I thought I'd also include this slide, which shows a significant fall in the number of people being declared bankrupt since the start of the pandemic in early 2020. So that's the insolvency statistics part done. I'd now like to take a look at what the ATO has been doing in recent years in terms of debt collection. As I say, the tax office is a key driver of insolvency appointments. This slide, taken from a recent Alaris Insights update, shows the number of quarterly court applications filed by the ATO since the start of 2018. And you can see that as soon as the pandemic hit in the first quarter of 2020, that the ATO has pulled back on virtually any court actions. Quarterly actions since then can be measured in the tens per quarter rather than in the hundreds before the pandemic. There's been a slight uptick in quarter 2 of 2022, and it's projected to continue to grow again in quarter 3, but still a long way off where they were at the end of 2019. The tax office has a number of tools at its disposal to enforce or encourage the payment of outstanding tax debts. As well as legal actions against companies and individuals, it can issue garnishee orders to banks to sweep funds out of company-owned bank accounts and pay the ATO directly without the debtor's consent or a court order. It can also issue directors with director penalty notices, and if those aren't responded to, those directors can become personally liable for outstanding company tax debts. The ATO has also begun notifying companies and individuals that if tax debts aren't paid, it will notify credit rating agencies and credit reporting bureaus of the defaults, which will negatively impact on their credit ratings. After adopting a relatively soft approach to collection activities since the start of the pandemic, the ATO announced in May this year that it's shifting back to firmer actions, particularly for those debtors who haven't been engaging with the tax office about outstanding tax debts and outstanding tax lodgements. Recently, the tax office advised that it has issued around 29,500 letters to debtors, warning them that they will be reporting to credit agencies or credit reporting bureaus for non-payment of their taxes. It's also issued approximately 53,000 letters to company directors, notifying them that they're at risk of receiving director penalty notices. Following those letters, the ATO began issuing around 30 to 40 director penalty notices every day, and it has begun notifying credit agencies and credit reporting bureaus of defaults. At that stage, it had been focused on those debtors that haven't responded to the initial ATO letters. More recently, the ATO has increased collection activity further with approximately 1,500 referrals to credit reporting bureaus of debts greater than $100,000. And it's now issuing around 120 director penalty notices every day. There are a number of different options for distressed companies. And when I talk about options, they're options for either the company or someone owed money from the company. This slide is just an overview of them, and I'll go through each in turn. The first appointment type is the court liquidation. In other words, a court orders that the company be wound up. This is usually done on the application of a creditor called the petitioning creditor, after the company fails to pay amounts owed to the creditor after being served with a statutory demand for payment. The court might also order that a company be wound up on just and equitable grounds. This is often because of a dispute between the company's shareholders who can't agree on the company's future or which party to buy the others out and for how much. Sometimes a provisional liquidator is also appointed when a winding up application is pending and there's concern that the company's assets might disappear before the application is heard. The liquidator appointed to the company has to be a registered liquidator, and all registered liquidators are regulated and licensed by ASIC. As it says on the slide, the liquidator's got wide-ranging powers, but their main duties are to sell assets, investigate the company's affairs and property, report to creditors and report to ASIC on their findings, look into possible recovery claims that include voidable transactions, breaches of directors' duties and insolvent trading claims. If funds are available, they'll pay dividends to creditors. And finally, they'll finalise the liquidation and have the company ultimately deregistered. So a liquidation isn't a process where the liquidator is trying to save a business, rather to maximise its return to the company's creditors. A creditor's voluntary liquidation is very similar ultimately to a court liquidation, but the company's directors and shareholders decide to make the appointment rather than the court. The company must be declared insolvent, and the directors and shareholders resolve to appoint a registered liquidator to the company. Once appointed, the liquidator has all the powers and duties as they have in a court liquidation. And it should be noted that the liquidator is acting in the interest of all stakeholders, and particularly the company's creditors. So while they were appointed by the directors, they owe them no favours and may end up pursuing them for any misconduct if that's occurred. In January 2021, a new type of liquidation was introduced, the simplified liquidation. And the idea being to do away with a lot of unnecessary time being spent by the liquidator on tasks with no real benefit to the matter, and therefore, in theory, to give a greater return to creditors. In practice, though, it likely means liquidators are writing off less time on low asset or no asset liquidations. A simplified liquidation starts off as a creditor's voluntary liquidation, and the directors need to give a signed declaration to the liquidator that they believe that the company qualifies for this simplified liquidation process. And the main eligibility criteria are as follows. The company's liabilities can't be greater than $1 million. The company and its directors can't have undergone a restructuring or used a simplified liquidation process in the last 7 years. And so that's the directors across any other directorships they might have. All company tax lodgements must be up to date, although any taxes owing don't have to have been paid. So what's different in a simplified liquidation as opposed to a standard creditors voluntary liquidation? The main differences are that there are no creditors meetings and no ability to have a committee of inspection. There's far less reporting. And if there'll be a dividend to creditors, then that only happens once and usually at the very end of the liquidation. The liquidator still has the same powers as in other liquidations. And if they determine that the simplified liquidation process shouldn't apply, they can stop the process. And that would normally happen if they uncover some sort of misconduct or avoidable transaction which they feel should be investigated further and pursued if there's a prospect of a financial recovery. On then to voluntary administration. A voluntary administration is a voluntary step taken by a company's directors. It doesn't need the input of shareholders. It's a requirement that the company must be insolvent or expected to become insolvent. If it's not, then the appointment can be voided by a court as an abusive process. I should also just go back and say that the appointment can also be started by a secured creditor who's got security over all or the majority of the assets of the company. Unlike liquidation, as the primary purpose of a voluntary administration is to save the company's business or a part of that business, and only if that isn't possible does the focus switch to maximising returns to the company's creditors. The director takes control of the company's business, although the directors still remain in office, but they're essentially powerless. The administrator then has wide-ranging powers and can sell the business, shut it down, shut part of it down, terminate employees, terminate contracts, and exit leases, as well as a lot of other things. The administrator also conducts an initial investigation to the company's affairs and property with a view to seeing if there are any possible claims against third parties, should the company ultimately end up in liquidation. And during the administration process, which typically lasts for about 6 weeks, the administrator also works with anyone, which is usually the company's directors or senior management, who wants to propose a deed of company arrangement to the company's creditors. So a deed of company arrangement, which is also referred to simply as a DOCA, is essentially a deal with creditors which will see a better outcome than the alternative, which is a liquidation. Towards the end of that 6-week process, the administrator issues a report to creditors detailing the findings from their investigations and evaluating any DOCAs put forward. And in that report, the administrator has to provide their opinion on what they think is best for creditors and the company. The administrator also convenes a meeting of the company's creditors at which they vote on the future of the company. And the 3 options that are available are to either end the administration and hand back control of the company to its directors. This rarely happens. I've seen it once in 20 years of insolvency. Another option is that they accept a DOCA that's been put forward. That's the deed of company arrangement. And there may have been more than one proposed. And the third option is that the company be wound up. In other words, that it go into liquidation. If a deed of company arrangement is accepted by creditors, then the voluntary administrator will usually become the deed administrator, and control of the company will at some point return to the directors. If creditors vote to have the company wound up, the voluntary administrator will more often than not then become the liquidator. In January 2021, at the same time that the simplified liquidation process was introduced, the government also introduced the small business restructuring process. And the small business restructuring process is very much like a simplified voluntary liquidation. Rather than have an administrator, the company appoints a restructuring practitioner, who again must be a registered liquidator. The key difference to a voluntary administration is that the restructuring practitioner doesn't take over the everyday running of the business. The restructuring practitioner's role is to help the directors to propose a restructuring plan to be put to creditors, which can be in any form, but would typically see creditors receive a percentage paid of their claims rather than 100 cents in the dollar, but which would give a better outcome than what they might receive in a liquidation. So there are eligibility criteria for the process, and the key ones being that the company's liabilities are not greater than $1 million, which will exclude a lot of businesses that are in distress. Another key criteria is that all employee entitlements that are due and payable, including all superannuation, are paid up to date. And that will exclude a lot of other distressed companies from using this process. If a majority of creditors who vote on the proposal vote for it, then it's binding on all unsecured creditors. But if the proposal isn't accepted, the company doesn't automatically go into liquidation, although that's likely to happen, as the process should only be started if the directors deem the company to be insolvent. So a receivership is an appointment made by a company's secured creditor or occasionally by the courts. Again, a receiver must be a registered liquidator. The appointment can be over all of the company's assets or just select assets. And that'll be determined by the secured creditor's security, the indebtedness to the secured creditor, or by any court orders. The receiver's role is fairly limited. They'll secure and sell company assets covered by their appointment. They pass the sale proceeds on to the secured creditor after deduction of their costs and any taxes. They have no reporting obligations to other creditors, and they don't convene any creditors' meetings. Often there'll also be a liquidator appointed to the company at the same time, and they'll be reporting to creditors, and the receiver will need to account to them for how they've sold the company's assets. Safe harbour. So safe harbour isn't a formal external administration process like what we've discussed already. There's no notification to ASIC of the process being adopted. And so it's difficult to monitor exactly how many safe harbour processes are being followed. So it's a process followed by company directors with help from their advisors to help provide a defence against a potential claim for trading the company whilst it was insolvent. An insolvent trading claim is against the directors personally for debts they continue to occur for the business after an established date of insolvency. From the point the directors appoint an advisor to give them safe harbour advice, the directors have a potential defence to an insolvent trading claim while they're working on a plan to save the business. If this is being done, it's important that the appointment and any decisions and plans are documented so they can later be relied upon if they're defending an insolvent trading claim. It isn't good enough to simply claim a safe harbour defence without written evidence to show that the process is being followed. The directors will often go into this process with advice from their legal advisors and also with an insolvency practitioner, a registered liquidator, to review the solvency of the company and to provide an assessment on whether the plan being considered is viable and will give a better outcome to creditors than if the company were to be wound up. Lastly, there's the option of attempting an informal restructuring of a company's business, which may benefit from advice being provided by a registered liquidator who can help explain to stakeholders what the alternative might be if an informal restructuring isn't achievable. There's no cookie-cutter approach to an informal restructuring, as it will depend on the company's individual circumstances. So this slide lists a number of possibilities. The restructure would normally start with a detailed look at the financial performance of the business, broken down into its separate parts. Then various things might be considered and implemented. They might include reducing headcount, exiting loss-making locations, exiting loss-making divisions, and that might be by simply shutting them down or trying to sell them off, outsourcing or offshoring of certain tasks to reduce costs, reviewing the pricing for their products, their goods and services, reviewing also the customer listing. Not all customers are necessarily good customers, particularly if they're not, if they don't pay promptly. And then also looking to renegotiate contracts and leases. Where stakeholders understand the need for restructure to ensure the ongoing viability of the business, an informal restructuring may be possible. If it fails, if stakeholders such as landlords and contract counterparties are not prepared to renegotiate, the next step might be to consider some of the options we've looked at today. So that brings me to the end of the presentation, and I'll now invite any questions. Might look first to see if any have been posted in the chat. Okay, I can't see any in the chat so far. Well, there are my details. They're included in the presentation. And I understand this presentation will be sent out to all the people who registered for the webinar. So thank you for your attendance today.